News about Fed hiking interest rates are no longer a secret for anyone. Before seeing how this could impact our life and affect the way we spend and live, let's see first what happened at the beginning of the medical crisis in 2020. The crisis in the United States and related business closures, event cancellations, and telecommuting policies have caused a recession. Serious uncertainty about economic paths have disrupted financial markets and intensified dire situations with a cash dash, which represents the desire to hold only deposits in the most liquid assets. The Federal Reserve has intervened with a wide range of measures to keep credit flowing to limit the economic damage from the crisis. Some of these measures were federal funds rate adjustment, forward guidance, and quantitative easing. Federal funds rate is the rate which banks pay to borrow from each other overnight. At its meetings on March 3, 2020 and March 15, 2020, the Federal Reserve Board lowered the federal funds rate target by a total of 1.5 percentage points to a range of 0% to 0.25%. The federal funds rate is a benchmark for other short-term interest rates and also affects long-term interest rates, so the move was aimed at helping spending by lowering the cost of borrowing for households and businesses. Another tool used by the Federal Reserve was the forward guidance offered on the future path of interest rates. Interest is the cost of borrowing money, usually given as an annual interest rate. It is one of the main tools central banks can use to try and slow rising prices, inflation. Soaring demand coupled with supply shortages as the global economy bounces back from the pandemic are sending inflation to new highs. So central bankers, who manage each country's currency and monetary policy, are taking action. Initially, it said that the rates would be kept near zero until it is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. In September 2020, based on the Fed's new monetary policy framework, that guidance was strengthened, saying that rates would remain low until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. Quantitative easing is another tool used by the Fed, who resumed purchasing massive amounts of debt securities. After 2 years upon the crisis start, interest rates are rising globally, and that will change the way we spend and save money. The United Kingdom Central Bank has raised interest rates for the first time in more than 3 years in December 2021, from 0.1% to 0.25%. South Korea, New Zealand, Brazil, Russia and South Africa are some of the other countries that has already raised interest rates in 2021. Let's see now how the hikes in interest rates will affect the way we spend and live. Interest rates and house loans. If you bought a house in the UK with a mortgage, your monthly repayment costs may go up. The amount will depend on the size of your loan. For example, based on an average mortgage of £140,000, UK Finance, the Banking Trade Association, estimates that the Bank of England's most recent rate hike will increase your monthly payment by an average of £15 a month. This applies to the 850,000 mortgage borrowers who have tracked mortgages, a type of variable rate mortgage. In the same time, you may see no change if your home loan is on a fixed rate, as 74% of home loans in the UK are, according to UK Finance. With an adjustable or variable rate mortgage that's already testing the limits of your monthly budget, you might want to refinance to lock in a fixed rate mortgage to reduce the uncertainty of rising rates. If you have other borrowing, like credit cards or car loans, the interest rate on these may rise as well. This worries policymakers worldwide about rising household debt globally, and the ability of consumers to pay back their debts. In the US, the average interest rate for credit cards is about 16% now. According to Ted Rossman, a senior industry analyst at creditcards.com, the upcoming rate hikes could get the credit card rates back around 17% by the end of the year. While that may only raise your monthly payments by a few dollars, depending on how much you owe, if you're already struggling to pay your bills, those few extra dollars could be an unexpected burden. If this is the case, now it could be a good time to look into all your debt consolidation options, including a balance transfer card or taking out a personal loan, and see what benefits you the most. Also, since lenders use your credit score to determine what interest rates you'll pay on loans, the easiest way to offset benchmark interest rate increases is by improving your credit score. High interest rates may be bad for borrowers, but great for those who have a savings account. This is because the federal funds rate is also the benchmark for the annual savings account, APY. When rates raise, banks react by increasing the amount you earn from deposit accounts. This means the APYs you earn on savings accounts, checking accounts, and certificates of deposit rises higher as well. In theory, higher interest rates mean that people receive a better return on their savings, which should encourage them to save rather than spend. In the same time, analysts warn that there is no guarantee of the higher bank rate being reflected in better returns on savings. Not all Fed rate hikes will directly affect you, and not all corners of your financial world will be affected by changes in interest rates. But keeping an eye on changes in the Federal Reserve's monetary policy is an important part of keeping your financial life organized. Rising rate needs to be handled with care by everybody, especially by the investors, and the best way to mitigate the impact of rising rates is finding the best asset allocation among stocks, bonds, and cash. Brian Stivers, president and founder of Stivers Financial Services in Knoxville, Tennessee, says that stock prices could go up when historically they have gone down. So, as in all types of markets, diversification is the key.